Welcome to episode 3 of Bookkeeping for Small Business Owners. Today, we're going to learn how to write down what you learned in episode 2. Specifically, we're going to learn double entry bookkeeping, the chart of accounts, and T-charts. On our pyramid of knowledge, this will take us through our early core knowledge layer. First, hi, my name is Christian. I'm the owner and chief bookkeeper here at Vitality Bookkeeping. If you're interested in getting your books taken care of, I'd be happy to help. Just visit my website, vitalitybookkeeping.net. All right, let's jump right in, starting with double entry bookkeeping. Double entry bookkeeping is how we translate the accounting equation into our bookkeeping records. It takes what we plugged in step 1 and puts it into a universally understandable accounting language. So what is it? Double entry bookkeeping is the formal system used by bookkeepers to record transactions. It's a method of bookkeeping where each transaction must affect at least 2 accounts. The logic here is that whenever money moves, it doesn't just appear out of nowhere and it doesn't just disappear completely. There's always a beginning and always an end to each transaction. As opposed to other accounting methods, the purpose of double entry bookkeeping is to write down where the money comes from and where the money goes. In other words, to keep track of how money flows through a business, which, if you remember, is exactly what a bookkeeper does. Thus, why bookkeepers use double entry bookkeeping. In addition to giving us the full picture, double entry bookkeeping also acts as a fail-safe and catches mistakes before they happen. More on that in a moment. First, let's get some context. The process so far. Bookkeepers keep track of how money flows through a business. They do this by recording transactions. Step 1 in recording a transaction is plugging it into the accounting equation. Step 2 in recording a transaction is writing down step 1 using the double entry bookkeeping method. So now that you've been introduced to the concept of double entry bookkeeping, let's learn how to use it and how to apply it. Double entry bookkeeping consists of 3 components: accounts, debits, and credits. Let's break each of them down. Accounts. Accounts are the specific categories transactions are recorded into. Accounts are used to keep track of money balances in a business, and they're used to keep track of money balance changes over time. If you recall the accounting equation, assets equal liabilities plus owner's equity, you'll remember that all bookkeeping transactions fall into one of those 3 general categories. If these are the general categories, accounts are the specific subcategories of those general categories. Example in a moment. Accounts are important because they're the fundamental building blocks of bookkeeping. When you record a transaction, the money in that transaction must be labeled under its correct account. In other words, all money must be categorized into an account. This categorization is the core of bookkeeping. Tracking account balances over time is how the flow of money in a business is tracked over time. We'll go over the various accounts and how to determine an account when we cover the chart of accounts later. For now, let's do one example to introduce the concept. Transaction number 1. Cookies Galore sells $200 worth of cookies and is paid in cash. Step by step. First, we know from the accounting equation that the business gained $200 in cash and the owner gained $200 in sales revenue, which adds to the owner's equity. Thus, $200 in assets equals $0 in liabilities plus $200 in owner's equity. Next, we determine the accounts. How do we determine the accounts? First, we look at how the money flowed. In this case, the business received $200 in cash, as well as the business earned $200 in sales revenue. We see the money affected 2 areas, thus we have 2 accounts. What are these accounts? Typically, the name of the account comes from the business's unique chart of accounts, or from accounting tradition and common sense. Once again, we'll get to these soon. In short, you identify where the money flowed, and then find the best label for where it flowed. On a very surface level, though, these accounts would be Cookies Galore gained $200 in cash, so it would simply label that account as $200 in cash, a cash account. Cookies Galore gained $200 in revenue from a sale, we would label that account sales revenue. Right now, it looks like this. Cash, $200 increase. Sales revenue, $200 increase. Once again, we looked at the flow, where the money went, and then we gave our best honest idea of what we would call the account that money went into or out of. So, to recap, accounts are the specific categories used to record transactions, and their purpose is to keep track of how money balances change over time. In this example, we identified the cash account and the sales revenue account. And if you're lost at all, here's the full context for how we got here. First, we looked at a transaction. Then, we determined how the money in that transaction plugs into the accounting equation. And then, we gave a specific label to the money based on where the money belongs on the accounting equation. And we call this specific label an account. So for example, we figured out there was $200 in assets, and that specific asset account was called cash. And we also figured out there was $200 in earned revenue, and we determined the specific name for that revenue account was sales revenue. And of course, sales revenue and revenue in general is a subcategory of owner's equity, which gives us the final result: $200 in assets equals $0 in liabilities plus $200 in owner's equity. And that breaks down into the accounts: $200 in cash, an asset account, equals $0 in any liability accounts, plus a $200 increase in the sales revenue owner's equity account. We will, of course, go into depth on this in the chart of accounts section later in this video. That said, having touched on accounts, let's now cover the two aspects of double entry bookkeeping: debits and credits. This is hard to teach, so buckle in. Debit means left-hand side, and credit means right-hand side. That's it. Before I explain more, it's crucial to remember which side is which. This trips up so many new bookkeepers, so it's very important to remember debits are left, credits are right. When written down, debits are abbreviated DR, like doctor, and credits are abbreviated CR. An easy way to remember this, and to remember which side is which, is to remember Dr. Craig. When you visualize the name Dr. Craig, you'll easily see that the DR is on the left side and CR is on the right side. One more important thing to note: debits are always written before credits. Think of it like reading order: left before right, debits before credits. All right, now that you know debits are left and credits are right, you might be wondering, left and right of what? They're the left and right hand sides of none other than the accounting equation. Yes, when it comes to assets equal liabilities plus owner's equity, debits are the normal balance for asset accounts, and credits are the normal balance for liability and owner's equity accounts. It's important to note expenses are debit accounts because they reduce owner's equity. More on that later. And with all of that said, you might be asking, what is a normal balance? As we know, accounts track money balances over time. An account's normal balance is simply whether that account increases with a debit or whether it increases with a credit. If an account has a debit normal balance, it's known as a debit account. If it has a credit normal balance, it's known as a credit account. As you might imagine, this lines up with the accounting equation. Assets are debit accounts, and liabilities and owner's equity are credit accounts. There is some nuance that we'll cover later. For now, though, just remember the normal balance tells us if the account increases with a debit or a credit. And just to recap, assets have a debit normal balance because they're the left hand of the equal sign in the accounting equation. And liabilities and owner's equity have credit normal balances because they're on the right side of the equal sign in the accounting equation. With that background covered, we can finally go over what debits and credits do. So, what do debits and credits do? Debits and credits are how bookkeepers change the money balance in an account. For debit accounts, debits increase them and credits decrease them, and vice versa for credit accounts, credits increase them and debits decrease them. We don't use the words addition and subtraction because when balancing an equation, those terms are inconsistent. So for example, if you had a debit account worth $100 and you want to subtract $30 from that, you wouldn't subtract $30, you would credit $30 from that account. And likewise, if you had a credit account with $50 in it and you want to subtract $20, you would debit $20 from that credit account. And vice versa, in that $100 debit account, if you wanted to increase it to $150, you would debit $50 into that debit account. And for the credit account, if you wanted to make that $50 $70, you would credit $20 to make it $70. And now that you've been introduced to debits and credits, let's go back to transaction 1 from earlier. Transaction 1. Cookies Galore sells $200 worth of cookies and is paid in cash. If you remember, we determined that this resulted in a $200 increase in the cash account and a $200 increase in the sales revenue account. We just learned that debits and credits are how you change the money balances in an account. So let's update the balances in the cash account and sales revenue account. First, let's identify where these accounts are at on the accounting equation. Cash is something the business owns, so it's an asset. Sales revenue increases the owner's claim, so it's owner's equity. Now that we've identified that cash is on the left-hand side and sales revenue is on the right-hand side, we know that debits are left and credits are right, so this means that the cash account is a debit account and sales revenue account is a credit account. To record this transaction, we need to increase the cash account by $200 and the sales revenue account by $200. Debits and credits change money balances in an account, so increase this account by using their normal balances. Therefore, we can finally officially record this transaction by debiting the cash account with $200 and crediting the sales revenue account with $200. If the cash and sales revenue accounts both started with a $0 balance, for example, then by debiting and crediting them in this way, we increase the cash balance from $0 to $200 and the sales revenue account from $0 to $200. And this final stage, debiting and crediting, is how professional bookkeepers look at every transaction. We look at a transaction and we immediately translate it into what the debits are and what the credits are. So for example, if Cookies Galore earned $200 in cash from sales, as a professional, you would immediately look at that and see debit $200 cash, credit $200 sales revenue. And getting you to that point will be the goal of next episode, episode 4. For now, let's review the process and how we got here. So, Cookies Galore received $200 in cash for selling cookies. Then we converted that to the accounting equation. $200 in assets equals $0 in liabilities plus $200 in owner's equity. And then we updated the accounts using double entry bookkeeping. Debit cash, $200, credit sales revenue, $200. The cash account and sales revenue account both increased their balances by $200. And the transaction, at least at this stage, is complete. Now, let's recap debits and credits. Debits are the left-hand side of the accounting equation. Credits are the right-hand side of the accounting equation. Debits and credits are used to change the money balances in an account. For debit accounts, debits increase the amount and credits decrease the amount. For credit accounts, credits increase the amount and debits decrease it. There's one last thing to go over. As we just recapped, when you get a transaction, you convert it into the accounting equation, and then from that, you convert it into debits and credits to update the accounts. What is implied here that I need to explicitly mention is this. Total debits must always equal total credits. Remember, debits being left and credits being right comes from the accounting equation. Assets are debit balances, and liabilities and owner's equity are credit balances. Therefore, assets equal liabilities plus owner's equity is the same as debits equal credits. One of the most valuable things about double entry bookkeeping is that it allows us to catch mistakes because we can easily compare how much is debited in total and how much is credited in total for a transaction. In the Cookies Galore example earlier, if you add up all the debit amounts in the transaction, you would get a total of $200, and if you add up all the credit amounts, you would get a total of $200, making the transaction balanced. If debits and credits are ever unequal, there's been a mistake and you need to review the transaction. And this example was easy to figure out because there's only one debit and one credit on either side. In future transactions, you might have things where there's 5 or 6 debits on one side, 7 or 8 credits on the other side, just these massive transactions. And what needs to happen is that when you add up all the debits from the transaction, all the credits from the transaction, that final amount needs to equal on both sides. Total debits must always equal total credits. So just to reiterate, it's only the total amounts that need to equal for each transaction. If Cookies Galore was paid $60 in cash, $140 in equipment, that would still be a balanced transaction because 60 plus 40 is 200. And of course, they earned $200 in sales revenue. $200 debits equals $200 credits. Of course, total. All right, now you're familiar with the 3 components of double entry bookkeeping: accounts, debits, and credits. With that, let's put the pieces of double entry bookkeeping together to get the full picture. Double entry bookkeeping is the formal system used by bookkeepers to record transactions. Double entry bookkeeping means every transaction must be recorded with 2 sides, a debit side and a credit side. For every transaction, total debits must equal total credits, no exceptions. That's it. If you want to put it in one sentence, every transaction has a debit side and a credit side, and these sides must be equal. Let's finish off transaction 1 by officially recording it with double entry bookkeeping. We left off by debiting cash for $200 and crediting sales revenue for $200. To complete the transaction under double entry bookkeeping, we must now make sure the total debits equal total credits. There's only one debit, $200 in cash, and one credit, $200 in sales revenue. Total debits equal $200 and total credits equal $200. With these being equal, we can now officially finish recording transaction number 1. So that brings up the question, where do we officially record a transaction? Where do we write it down? We'll answer that question in episode 5. For now, there are 2 more key concepts we first need to understand: the chart of accounts and T-charts. Earlier, we talked about accounts, which are specific categories used to record transactions, so we can track money balances. We just learned that debits and credits are how you change the balances in these accounts. Now, we need to know what those accounts are and how to organize them. This is where the chart of accounts comes in. The chart of accounts, as you might have guessed, is the master list of all accounts in a business. Think of it like a filing cabinet or a menu at a restaurant. The chart of accounts is made up of 5 categories. Every account falls under one of these 5 categories. These 5 categories are assets, liabilities, owner's equity, revenue, and expenses. Sounds familiar? That's because the chart of accounts is made up of the categories in the accounting equation. If you picture it like a filing cabinet, these are the 5 main folders. And the individual accounts go into one of these 5 folders. If you picture a menu, these are things like breakfast, lunch, dinner, and the individual accounts are the foods and drinks within those categories. So we have the chart of accounts in the 5 categories that make up the chart of accounts. Now, how do we determine what accounts go into the chart of accounts? So every business does have their own unique chart of accounts, but the secret is that a majority of those accounts are virtually the exact same between businesses. This is because the way money flows through a business is usually the same between businesses. That said, certain niches and industries do require special accounts, which are generally intuitive to figure out once you get to that point. For now, though, let's cover the main accounts for each category and fill out our chart of accounts. Assets. Under the assets section of the chart of accounts, as you might guess, are the accounts for what the business owns. Asset accounts break into 2 categories, current assets and fixed assets. Current assets are cash or assets a business will convert into cash within 1 year. In cash-basis bookkeeping, the only current asset account you'll use is cash, although some may track inventory. So, common current asset accounts are cash, usually broken into specific types such as bank accounts, usually the bank name, the type, and the last few digits, such as Wells Fargo checking, 1234, Chase Savings, 4321, so forth, undeposited funds, or cash that hasn't been deposited yet, and petty cash, which is just cash that is readily available and easy to access. Inventory. Inventory might be the only other current asset you track under cash basis. But as I mentioned, you probably just want to track cash, and it's better to track inventory separately and then reconcile with your books at a later date. And if you do want to make the switch to tracking inventory in your books, I recommend talking with a CPA first, just to make sure everything's dialed in. Fixed assets, as you might have guessed, are assets that you expect to last more than a year. There is some nuance though. If the asset is less than $2,500, it can be expensed rather than made a fixed asset. The $2,500 limit is called the capitalization limit and can differ based on company policy. More on this later. That said, common fixed asset accounts are equipment. Equipment accounts usually track the value of things like machinery, furniture, computers, so forth. Usually with the name being something like equipment dash type of equipment, equipment dash office, equipment dash machinery. Vehicles. Similar to equipment, this account tracks vehicles used in a business. Land. Tracks land owned by the business. Buildings. Tracks buildings owned by the business. And those are your fixed asset accounts, generally speaking. Equipment, vehicles, land, and buildings. Assets are pretty sparse under cash basis, but to recap, asset accounts are broken into current and fixed assets. Current assets are cash, or assets that will be turned into cash within a year, and fixed assets are assets that will last longer than a year. The main asset accounts are cash, undeposited funds, petty cash, inventory, equipment, vehicles, land, and buildings. Liabilities. Liability accounts are accounts for what the business owes. Similar to assets, there are current liabilities and long-term liabilities. Current liabilities are liabilities due within the year, and long-term liabilities are liabilities due after a year. Under strict cash basis bookkeeping, you don't usually track many liabilities because you only record expenses when you pay for them. The main current liability accounts are accounts payable, also known as bills, credit cards payable, which is credit card debt, and payroll taxes payable, which are the payroll taxes the business owes. Long-term liability accounts include mortgage payable, which is debt for property, and loans payable, which are loans. If we condense this down, the main liability accounts are accounts payable, credit cards payable, payroll taxes payable, mortgage payable, and loans payable. Owner's equity. Owner's equity, as you know, is the owner's claim to the business's assets. In a cash basis business, there are 3 main owner's equity accounts. Owner's capital. The owner's capital account tracks what the owner invests into the business, sometimes called owner's investment, shareholder capital, or partner capital, depending on the type of business and preference. Owner's draw. The owner's draw account is used when the owner withdraws money or assets from the business. And retained earnings. The retained earnings account is used to track a business's cumulative profit and loss. When you subtract expenses from revenue, the total goes into retained earnings. So for a quick summary, the three main owner's equity accounts are owner's capital, owner's draw, and retained earnings. Revenue. Revenue accounts cover the gross earnings of a business. The main accounts are sales revenue, which is money made from selling goods and products, service revenue, which is money made from providing services, interest income, money made from interest, usually from bank accounts or investments, and then miscellaneous income, which are just other sources of income such as rebates, one-time gains, so forth. Straightforward, the summary of revenue accounts is this: sales revenue, service revenue, interest income, and miscellaneous income. Expenses. Expenses are a convenient way to reduce the amount of taxes someone pays in their business. This is because, as you know, expenses directly subtract from revenue. As a result of reducing taxes, business owners do everything they can to find expenses. Not every purchase is a business expense, though, and expensing things that can't be expensed can lead to serious issues with the IRS. Teaching everything that can be expensed and everything that cannot be expensed is a massive undertaking and beyond the scope of this course. That said, a good rule of thumb is this: an expense is something both ordinary and necessary for operating a business. Ordinary means it's typical for that type of business, for example, coffee beans for a coffee store. And necessary means it's helpful and appropriate, even if it's not absolutely required. For example, marketing for a business. Once again, expenses are the ordinary and necessary costs of running a business. The main expense accounts are cost of goods sold. These are the costs directly tied to the goods you sell. These are the required costs for making the product. If you sell shirts for $20 and it costs you $10 to make them, that $10 would be considered the cost of goods sold. Rent expense. This includes equipment as well as the typical buildings and land that you might rent. Utilities expense, salaries and wages expense, payroll taxes. This is when you pay off the payroll taxes payable from earlier. It's important to note that income taxes are not an expense from your business. They're a personal expense, unless you're a C Corp, which is a very specific situation. So that said, payroll taxes are an exception, and you can write off payroll taxes as an expense. Marketing expenses, the cost of promoting your business. Supplies expense, cost of things like pencils, staplers. Professional fees. These are payments to people like lawyers, consultants, and bookkeepers. So yes, you can write off a bookkeeping expense. Travel expense, meals expense. Important to note about meals though, there are strict rules around meals to where on your taxes, you can only take 50% of what you spent on business meals as a deduction. Just keep that in mind. For your bookkeeping though, you record the full amount. It's just when you do your taxes later, you can only take half of that. Interest expense and insurance expense. And I know I read out every account for the other categories, but there are so many expense accounts that I'll spare you the monotony and not read them out. And with that, we round out the list of the most common accounts you might find in a business. Collectively, these accounts are known as the chart of accounts for the business and are organized based on where they land in the accounting equation. In fact, a common way of organizing the chart of accounts is labeling each account with a number. Assets starting in the 1000s, liabilities starting 2000s, owner's equity 3000s, revenues 4000s, and expenses 5000s. For example, cash might be labeled account number 1001, and supplies expense might be labeled something like 5015. This numbering system is totally arbitrary though. It's just how I do it personally and what I would recommend doing for your own business. All right, so far this episode, we have covered accounts, which are specific categories used to track money balances over time. Debits and credits, which are used to change the money balances in an account. Double entry bookkeeping, which is the official way transactions are recorded, which states every transaction has a debit and a credit side, and total debits must equal total credits. And now, chart of accounts, the master list of all accounts in a business. Let's finish off the episode by covering T-charts. T-charts are the visual representation of an account. They're used as a way to easily view the balance history of an account. You can think of looking at an account's T-chart like using a magnifying glass on the account. When written out, T-charts look like the letter T, with the account name on the top, debits on the left, credits on the right, and the net total at the bottom. Let's do 2 transactions to introduce the concept. And let's say before doing these transactions that Cookies Galore has this hypothetical, very basic chart of accounts. And we're going to go over transaction number 1 again so that we can view it through the lens of a T-chart. All right, transaction number 1. Cookies Galore sells several trays of cookies and earns $200 in cash. As we just learned, the purpose of a T-chart is to visualize what happens in an account. So let's use a T-chart to see how this transaction looks. First, we look at the cash T-chart. Notice the account name at the top, the debits on the left, the credits on the right, and the current total at the bottom. In this transaction, we debited cash $200. Therefore, we write $200 in the debit column. Once we've updated the account, we add total debits and total credits, then subtract from the normal balance. Once we've updated the accounts, we add total debits and total credits together, and then we subtract from the normal balance. The point of a T-chart is to be able to easily do this visually. In this case, we see $200 in debits and nothing in credits. Total debits $200, total credits $0. The normal balance for cash is debit, so we subtract credits from debits. $200 minus $0 equals a net total of $200 for the cash T-chart, or the cash account, in other words. Much quicker now, here's the sales revenue T-chart. We credited sales revenue $200, so we jot that down. Sales revenue increases owner's equity, so it increases the right-hand side of the equation and therefore has a credit normal balance. Therefore, we subtract debits from credits this time. $200 minus $0 equals a net total of $200 for the sales revenue account. After updating everything, Cookies Galore's chart of accounts would now look like this. Transaction number 2. Cookies Galore spends $30 in cash for kitchen supplies. Step by step. This decreases the cash account by $30 and increases the supplies expense account by $30. Cash is an asset, which decreases with a credit. Supplies expense is an expense, which increases with a debit. Wait a minute. Aren't expenses on the right-hand side of the accounting equation? Doesn't that mean they should increase with a credit? We have touched on this before, and this is the final point about debits and credits. And that is, it's true. Debits are left and credits are right. Assets are debits, and liabilities and owner's equity are credits. It may not be obvious, but expenses being debits actually follows this rule. Think of it like this. Debits decrease owner's equity. Expenses decrease owner's equity. Therefore, expenses must be debits. And expenses need to be in the owner's equity section because expenses directly reduce the owner's claim to the business's assets. If you remember, there are 3 main categories: assets, liabilities, owner's equity, and 2 subcategories: revenues and expenses, when it comes to accounting. Another way to remember which of those categories are debits and which of those categories are credits is the acronym DEALER, spelled D-E-A-L-E-R. The DEA is on the left-hand side of dealer and stands for draws, expenses, and assets, the 3 debit accounts. The LER is on the right-hand side of the word dealer and stands for liabilities, equity, and revenue, the 3 credit accounts. All of that being said, though, I much prefer you just remember the accounting equation, assets equal liabilities plus owner's equity, and you remember that on the left-hand side, things that add to the left-hand side are debits, things that take away from it are credits, and likewise, on the right-hand side, things that add to it are credits, things that take away from it are debits. And if we apply the acronym DEALER to that, draws take away from the right-hand side, so they're debits. Expenses take away from the right-hand side, so they're debits. And assets add to the left-hand side, so they're debits. And likewise, the LER, liabilities, add to the right-hand side, so they're credits. Equity adds to the right-hand side, so they're credits. And revenue adds to the right-hand side, so they're credits. So although you can use the word dealer to help remember, I do prefer that you just fundamentally learn the accounting equation itself. That said, let's go back to T-charts and back to transaction number 2. So, where we left off. Cookies Galore spent $30 in cash to buy kitchen supplies. We just recognized that this is a $30 decrease in the cash account and a $30 increase to the supplies expense account. Therefore, we debit supplies expense $30 and credit cash $30. We add up total debits, $30, and we add up total credits, $30, and see the total debits and total credits are equal. Therefore, the transaction is complete. Now, let's use T-charts to see how this transaction looks. First, we look at the cash T-chart. At the bottom, you see the current total is $200 from transaction number 1. We just credited cash $30, so we write that down. As a debit account, we subtract credits from debits. $200 minus $30 equals a net total of $170 for the cash account. You might be thinking, wait, shouldn't total credits equal total debits? That rule only applies to individual transactions and when you compare all the accounts in the business at the same time. So yes, in a single transaction, in the books overall, the totals must be equal. For each individual account, though, total debits do not need to equal total credits. In fact, most of the time, the normal balance will be higher than the opposite of the normal balance. If you have an account where the opposite is true, where the non-normal balance is higher than the normal balance, that's actually a red flag, and you should check that out to make sure that everything is correct in that account. And with that said, we see now that the cash account has a final total of $170 debit. Now let's look at the T-chart for supplies expense. We debited supplies expense $30, so we write that down. Expense accounts have a debit normal balance because they reduce owner's equity. Therefore, total debits, $30, minus total credits, $0, equals a net balance of $30 as a debit for the supplies expense account. Therefore, total debits, $30, minus total credits, $0, equals a net debit balance of $30 for the supplies expense account. Now, if you remember, here's what Cookies Galore's chart of accounts looked like before transaction number 2. Here's what it looks like now after updating from their second transaction. Without T-charts, we would simply see the name of an account, and then we'd watch the balance next to it change with each transaction. With T-charts, however, we can see the exact breakdown of how we arrived at each amount and each balance for that account. You don't need to use T-charts while doing your bookkeeping, but they can be helpful. Think of them like a tool for when you want to learn more about an account, or if you're trying to figure out a problem. This is how most bookkeepers use T-charts. All right, that's everything for this episode. To recap, we learned the following concepts and the nuances. Double entry bookkeeping, which includes accounts, debits, and credits, the chart of accounts, and T-charts. All right, everything we've learned so far is very conceptual, and it's time to solidify it. We have enough information to properly record transactions, so next episode will be an episode of nothing but practicing transactions. We'll be going over transactions that you haven't seen before, so I'm making it part of the main series as opposed to a bonus episode. The goal will be to get you to the point where you can look at a transaction and immediately have the instinct to know what to do the same way a professional bookkeeper would, taking you from the level of thinking to the level of knowing. The episode after that, we will return to our knowledge pyramid and learn about journaling and ledgers. If you have anything on your mind or you have any questions, go ahead and leave a comment. If you're interested in getting your books taken care of, I'd be happy to help. Visit vitalitybookkeeping.net. Otherwise, thank you for watching, and I'll see you in episode 4.